Step into the metalverse, a vast, ever-evolving realm where industrial metals take shape amid shifting prices, market trends, and supply chain forces. But what does it all mean for you? Welcome to Cup of Joe. Named in honor of our founder, Joseph T. Ryerson, we help you navigate the metalverse, one conversation at a time.
Hey everyone, welcome to the May episode of Cup of Joe. So glad you're with us this month. What you're about to see is a different format to when we had our live show on May 1st. So normally it's live, right? Nick and I, and then bring on a guest. Nick was unavailable to be live, so we recorded his segment 2 days prior. And you'll hear us reference throughout when we talk to the product managers. And what we mean by that is during the live show, we had Jim Reed, our director of supply chain on the West Coast, and Brian Crane, product manager for Carbon Flat Roll, will join us for the live show. But on this recording here, you're just going to see the straight commodities update and macro update that Nick and I went through a few days prior. We do have the commentary from the product managers, which we'll make available on a follow-up episode. So just wanted to give a little flow of the show here. And as always, good stuff. And thanks for joining us. Hope you enjoy the show. Here it goes.
All right, Mike. We got a lot to cover here this month. And to all of our viewers, sincerely apologize. I'm not able to be there live. But as we will reiterate a few times, we will certainly have a couple different avenues for taking any live questions that our product managers are not able to handle. But let's go ahead and get into the macro content and the commodities content. First things first, as we always do, got to cover the safe harbor provision. This is not investing advice. This is not legal advice. Do your own research. But we got a lot of really good information in here today, and I think you're really going to enjoy it. So this is really the crux of what I want to talk about from the macro side of things. This is getting a lot of traction within social media sites, so Twitter, X, CNBC, and that's this notion that we hinted on last month, but it's this idea that we're seeing very large divergences between what's called hard and soft data points. Hard and soft data is no more than saying a soft data point is something that's done in a survey, like a purchasing managers index or University of Michigan's consumer confidence data. That would be more on the soft data side, whereas hard data would be actual sales, shipments of things. It would be durable goods orders, which I think we highlighted in last month's Cup of Joe. And so the hard data is going to be shown here in this chart in the black line. And then the blue line, which you can see just falling off a cliff right now, is the soft data. So that's going to be your survey data that's looking quite ugly on a relative basis. Now, it's interesting because if we go back to both 2023 and 2024, we saw instances of this occurrence where the soft data really kind of fell apart and the hard data didn't move a whole lot. And the outcome of that was different in both instances. So back in 2023, you can see the blue line kind of collapsed off away from the hard data. And then it turned out that the hard data actually led it all back higher. So the survey data ended up snapping back up to catch up to the hard data, which didn't even go lower, it actually went higher. The reverse happened in mid-2024, where the survey data started to move substantially lower, and it looks like it actually led the hard data declines. So we don't know how this one's going to play out, but I've got a couple different charts and pieces of information I want to share to just give us a context of where we're sitting right now and how we could potentially see the hard data catch down to the softer survey data, or it could be more of an instance like 2023 where the survey data just ends up being temporary and then snaps back up to the positive side.
Nick, what's the number represent the scale from 1 to negative 150?
Yeah, so that's going to be, so a lot of these, if you look down to the bottom left corner, these are the economic surprise indices. And the way those are done ultimately is it's all relative to what analyst expectations were. So if expectations were, let's say, flat and it comes in negative, that would be a negative impact to this index. So it basically the high and low of it is about 1 and -1 is roughly as good and bad as it can get. But it's a gauge relative to analyst expectations for each one of these indices.
Remind me what was going on in the spring of 2024 that led the soft data so low?
Man, I don't recall the specific
Yeah,
data that would have been driving a lot of that. I mean, I would think some of that would have been inflationary data points that people just weren't feeling good about prices coming down fast enough, and people could have been concerned about that. But
yeah,
I don't recall these specific indices. We'll certainly run through a number of them here today to give you an
yeah,
idea of where some of that data is really softening.
yeah.
Admittedly, it honestly feels worse within the survey data now than it did back then, in my opinion.
Okay. All right, let's take a look.
So first things first, if we look at the consumer, so there are a couple different ways we can look at the consumer, and we've got a couple here within this presentation. This is looking at consumer confidence, which is going to be data points put together by the conference board. And again, that's just a survey that goes out that says, how you feeling about the economy? How you feeling about spending plans? And you can see that that white line, which is the consumer confidence, has basically tailed off to levels we haven't seen since the COVID lockdowns. So that seems pretty darn severe to me. If we were to correlate that to the last recession, that's the kind of territory we're in right now from a survey standpoint. But overlaid against this, we've got the hard data, which is going to be retail sales. So that's going to be looking at, how our consumers are actually spending money. And you can see it's a much flatter line. It's certainly got its month-to-month gyrations, but they're much tighter bands. And if anything, the most recent data point of 1.4, 1.5% is pretty decent relative to where we've been over the last couple of years. So retail sales is telling the story that the consumer hasn't yet changed its spending behavior, but yet they just feel really bad. And it's interesting. I was listening to an interview this morning with the CEO of Coca-Cola, and he cited something very, very similar, which was, he said a lot of the expectation related surveys are showing dire conditions, but yet consumer behavior isn't really moving all that much. If anything, it's kind of trending the same and maybe even growing a little bit. So I think we're seeing a fair amount of that. And we look at it in a variety of different ways. This is just looking at TSA checkpoint data. It's been a while since we looked at this. I think we probably spent some time on this maybe 3 years ago when we were when we were trying to see how the reopening was going.
Yeah.
And again, this is one that I find interesting and perplexing because about a week ago, the CEO of Southwest Airlines came out and said, we are for sure in an airline recession. And I pull up this chart and I say, I don't see it. It sure doesn't look like it when you look at the number of passengers going through checkpoints. And you can back to the pre-COVID numbers, just eyeballing, it looks like we're actually up relative to many of the pre-COVID numbers. So we're off the record highs, but that record high number was a blip on Thanksgiving back in 2024, and it was only maybe 10% higher than where we are now. So I view at least the spot data to be quite strong. There's a chance that the Southwest Airlines CEO was looking at something regarding bookings. Maybe it's 3 months out or 6 months out. Maybe the bookings data isn't looking all that strong, but and I don't have access to that data. But just looking on a spot basis, people are still traveling. People are still spending money on flights.
Even if he is looking 3 months ahead, right? It'd be hard to call that a recession, maybe, especially with the number or an airline recession, right?
I would think so.
Unless it just falls off a cliff going forward. Now, this is global, right?
This
Global
is United
travelers?
States. This is U.S.
United
TSA.
States. Okay.
Yep.
Okay.
Yeah. So fair point. I mean, there could be indices internationally that look a whole lot worse just because people are kind of, traveling away from the United States because they're angry at the administration. That could be happening. I have not seen that data, but just looking at the U.S., it's certainly holding up strong.
So these could be flights booked to get out of the United States.
that is fair. That
gotcha.
is fair.
Okay.
And similarly, looking at the hard data, and again, this is spot data, so this isn't expectations for future spending, but looking at U.S. auto sales, and I will readily admit it does look as though there's some pre-buying in advance of the tariffs. But nonetheless, even before the pre-buying of the last month or two, the numbers really aren't all that bad. So when we think about how's the consumer doing, how's the consumer spending? Well, based on auto sales, they're still spending at a pretty decent clip. It's not quite back up to the pre-COVID levels, but the latest data point, in fact, is. Now, again, I fully acknowledge that's a little bit of an asterisk of people probably trying to get out in front of any tariffs related to auto parts and foreign vehicles and things like that. But these numbers don't look dire. They certainly don't look like we're tail spinning into a recession the way that the consumer confidence data point shows here. Because you think about those, business activity back during the lockdowns, things came to a standstill, and it was a mandated standstill. and people are feeling that bad right now, which is curious, I think.
Just anecdotally, I don't know about you, but excuse me, on the radio, there's commercials. There's one in particular for a local furniture maker who is saying, get ahead of not get ahead of the tariffs, but um, everything is domestically made, right?
Yep.
So you don't want low quality furniture from overseas, and they're specifically talking tariffs, right?
Yep.
Which is really interesting.
Hey,
To
if you,
the common person getting that right, and there may be some I don't want to say taking advantage of it, but like spinning that narrative, so maybe people are purchasing more right now. I
Hey,
don't know.
in business, even if it's a lie, if it can pick up some sales, I think it's worth doing. But I think,
Yeah,
I think it makes sense for domestically sourced to domestic supply chain companies to air that right now. I think that's certainly advantageous to do so,
yeah, yeah. I thought it
even
was
even if it's
interesting.
not fully embedded into the economy yet.
Right. Yeah.
Similarly, if we look at inflation, how expectations around inflation are relative to what the actual inflation data says, the inflation expectations is going to be the white line shown here on this chart. And this is the University of Michigan, which we already know is flawed data because it's the University of Michigan.
Ohio State, right?
But
For
the
those who don't.
University of Michigan puts together inflation expectations for 1 year forward, and then they do one for 5 years forward. And this particular index is for 1 year forward. Where do you think inflation is going to be in 12 months? And then overlaid against that, we've got actual CPI data. So that's actual, what's the basket of goods saying in terms of price increases, decreases. And you can see that at least going all the way back to 2016, we are seeing the largest divergence between expectations going higher and the actual inflation data actually going lower. And the spread right now is about 4%. So, why are expectations so elevated? Well, admittedly, there are a lot of economists out there, a lot of very smart people who are saying they fully believe that these tariffs are going to be inflationary, and not just inflationary to the extent it's even larger than what we expected back in 2021, 2022, when CPI was all the way up at 8-9%. They're thinking it's going to go even further than that. What I find curious about that is some of those same people are also saying that these tariffs are going to take us into recession. And I find those two things a little bit conflicting because it's sort of tough to have massive price increases and at the same time having a demand recession. But I found this one to be quite curious because inflation expectations have absolutely ripped while the actual hard data is somewhat stable. This will be an interesting one to track over the next 3 to 6 months, I would say, when we actually see the foreign supply chains coming into America, getting hit with tariffs. What does that ultimately do for the finished basket of goods, which would track in the CPI? And I think this is one of the reasons, potentially one of the reasons Jay Powell and Donald Trump are kind of at odds with one another, because he's kind of looking at this market saying, maybe we should wait and see if these inflation expectations come to fruition. And I think the current administration is kind of saying, well, CPI is pretty low right now. Get your rates lower so we don't screw up the economy. So it's an interesting dynamic right now.
And maybe you have a slide on this later, but I'm going to take us off the lane here. But
Good.
where are we with it's a 90-day delay on tariffs, right? Was it 90?
Yeah,
Okay,
there was a 90-day,
we're
although the automotive tariffs, which just this week, actually just today, on the day of filming, there has been a little more dialogue around automotive tariffs not stacking. So it looks like there's probably going to be a 25% tariff on automotive products beginning early May. I believe it's May 3rd.
okay.
But the good news for the automotive companies is it's not going to stack on one another. So you're not going to see 50 or 80 or 100% tariffs on automotive products. It looks like it's probably going to be somewhere around 25%. And then there may be some sort of rebate program that's going to develop over the next 3 years. It's such a tricky one because it almost seems like the tariff dialogue is getting more complex, not less complex, where you're seeing these rebates that are sort of tiered each year. But yeah, you are correct on one of those sets of tariffs did get the 90-day delay.
Yeah, and we're still basically do you, and I don't want to steal your thunder, right? But like, is it it'll come to a point, right, where you get make a deal with one country and perhaps the
Yeah.
dominoes fall from there.
Yeah, and I certainly have some slides on this, but
Okay.
I do think we
I figured.
are incredibly close to getting some sort of announcement.
Yep. Okay.
And maybe by the time we're actually doing the live airing of this, we'll have firm confirmation of that. But the Howard Lutnick earlier today just said that they do already have a memorandum of understanding for one of the countries. They just need final approval to sign off on that. So I expect in the coming days, weeks, we're going to start to hear about some of these. But yeah, I've got a list on who the biggest priorities are on.
You got to guess at who the member of understanding is with.
I've got a pseudo educated guess, and I'll give you that list here in just a few slides.
Put up your disclaimer again.
And I certainly don't want to talk politics too much, but in some cases we have to. And this isn't to say right or wrong or one side is better than the other. It's just to say that the data is kind of fascinating. This is maybe the last one of the, let's say, hard data versus soft data, or said a different way, how politics can potentially impact some of these surveys. This is looking at, it's kind of cool that they do this. I don't want to give too much credit to University of Michigan, but when they split out their consumer sentiment data, the headline number, which is shown in the white line, as compared to the same survey for conservatives, which is going to be shown in blue, and then Democrats, which is shown in orangish red, you can see that depending on who's in office, there's almost an inverse flipping on how that consumer of that particular political party feels about the economy. What I would quickly point out is over here on the right-hand side, since the election of Donald Trump, Democrats have essentially viewed the economy and the consumer in a very, very dire light. You can see that orange line is at its lowest level going all the way back to 2018. And that includes an actual recession and global lockdown from COVID. And Democrats are, per the survey, feeling worse than they have over the last, let's say, 7-8 years. Conversely, conservatives are actually feeling better about the consumer situation versus 6-8 months ago. But based on the headline number, all it's tracking is the overweighting of the Democratic side. So it's actually moving lower on a headline basis. But you peel back the onion and start to see, kind of depends on where in the country you are, kind of depends on who you voted for. Yeah. And that's why some of these surveys seem to be getting a little bit dicey, or I don't want to use the word convoluted, because it is representation, and you want to have both parties involvement, but it does seem as though their impact is getting more polarized, I guess.
Yeah, you can see that play out and open up your Twitter feed, and you know who's a Democrat, Republican, and what they're saying, right? It's almost interesting.
That's right. And I think this, again, not trying to talk politics too much, but I do think that this is part of why we're seeing some of the survey data look so abysmal over the last couple data points, because they're pretty upset with what the administration is doing from a tariff standpoint, from a deportation standpoint, and they're reflecting that within survey data, at least to some degree, it seems. Now, speaking of surveys, this is one we tend to like, looking at the global PMIs. Because we are not doing this on the first of the month, and I sincerely apologize, I know some people really like this chart, because we are not on the first of the month, we don't yet have all of the April data points. But the good news is S&P Global does do a flash PMI right around the 22nd of each month. So we do have a couple of these data points, and for the United States, it's actually slightly higher on a month-over-month basis, up at 50.7. You scroll your way down to some of the European regions, they're a little better, kind of orange territory relative to what we would have seen where we were in deep red. So maybe slight incremental improvements there in terms of how their negative growth is tracking. India continues to be going gangbusters, just deep green. And I think they really are a big beneficiary of a lot of these trade negotiations. They're kind of sitting as that innocent bystander while the US and China have a giant embargo type standoff. And I think India is going to be a big beneficiary in these trade discussions, where they're kind of a neutral type party with a lot of, a massive population and a growing economy. And I think they're going to have some levers to pull on both sides with China and the United States in these trade discussions. Now, this one's a bit spooky. This one's made its rounds over the last couple days, and this is looking at the Dallas Fed business outlook. overlaying it against the ISM headline number. And again, because we're not on the first of the month, I don't have the latest ISM numbers, but people are trying to use this Dallas Fed index, the Dallas Federal Reserve, as a proxy for where we could ultimately potentially expect the ISM to land. And if you look at the white line, which is going to be the latest Dallas Fed index, it's suggesting we could see some fireworks to the downside in the ISM survey. We'll have to see. I do think it's worth caveating the Dallas Fed survey, because this is specifically to Texans, and I do think it's worthwhile noting that one of the big economies within Texas obviously is oil.
Yeah.
And in the last 2 months, we've seen oil prices get into pretty tricky territory for producers of oil. We're getting down around $60 a barrel. That's getting pretty close to the break evens of a lot of shale producers and just U.S. producers of oil. So you could imagine that even if you're conservative, filling out one of these surveys, if you're in the oil and gas industry, probably not feeling real great about the current situation, because prices are such that drillers are not making a ton of money right now. So I do think that's an important caveat to all this that could be driving the Dallas Fed survey a little more negative. But by the time you guys do the live recording with the product managers, we should have this latest ISM data out. Now, this is where we get into the crux of trade. And over on the left-hand side, I've highlighted 18 different countries. And why did I highlight 18 countries? Earlier this morning, Secretary Scott Bessent was on CNBC, and he said, there are 18 key agreements that we are working on. And he said, put one of them aside, which is China, because we are not currently in negotiations with them, which I thought was pretty interesting, that they really aren't even making any headway whatsoever. But he said on the other 17, we are making headway. And so those other 17, I tossed it into one of the AI models to find out who the other 17 were based on trade deficits. And these are the other 17 largest trade deficit trading partners. My estimation, and based on some of the things I've been hearing, is that Japan, South Korea, and India are the closest to the finish line as we sit here right now.
Okay.
Perhaps worth noting, Canada just had their elections yesterday. They probably need to get that behind them before they could proceed with more meaningful discussions. But these are the 17 I think we want to watch. And in my personal opinion, I think it needs to happen in the next couple of weeks. And I do think we will begin to see some of these success stories. We'll see what that success looks like, but some of those success stories over the next couple of weeks. And the reason why I think that's the next couple of weeks is so important is because we're seeing a lot of headlines talking about, importation of back to school related items, Christmas related items. It's crazy. We're already thinking about the fall and winter of next year. But as I understand it, a lot of the big box retailers, this is about the time when they've got to be planning those supply chains and what they're going to put on the shelves for back to school, for Christmas, for the holidays. And if these trade discussions break down in the next few weeks, those things could be at risk to having empty shelves again, circa 2021, 2022 type situations. And if they're not empty, they're at the very least going to be much more expensive because of those tariffs. So that window to getting these discussions done for kind of fiscal 2025 earnings and corporate results, we're in a window that's pretty important, it seems, right now. So I tend to think we're going to see a lot of these names over on the left-hand side affiliated with Truth Social posts from Donald Trump saying, how big of a deal it is that we've gotten some of these trade deals done. It'll be interesting to see what they all look like. But over here on the right-hand side, I think we've looked at a chart kind of like this, or a table kind of like this. But this is looking at who was a bigger trade partner with China in 2000 versus who was a bigger trade partner with the United States, and then comparing that to 2024. And the reason why I think this is important context to keep in mind is that when the U.S. is going in to try and negotiate any of these trade deals, my guess is they're trying to get something from that nation to say, we will pull back a little from China. It basically in an effort to sort of slow this red wave that's spreading across the entire world. And I'm not here to say whether that's good or bad, but nearly every nation outside of North America and a little bit of Europe is a heavier trading partner with China these days. Wow. So it's becoming a bigger and bigger ask for somebody like the US to go in and say, hey, come back and be friends with us, be less good friends with them. So it's definitely a big wall to climb, I would say.
Yeah. To your point on the countries next, I would think, and then this isn't a guess or anything, but I would think Mexico would be. I mean, if you ask me when this thing started, and just because they seem to cooperate right away, right?
Yep.
And it almost seems like do they seem further away than Canada for making a deal? But it seems like they did. There's probably motivation on both sides for
Yeah,
United States and Mexico.
I tend to agree with you. I mean, politically, it seems like President Sheinbaum is at least on paper much more cooperative with the current U.S. administration.
Hmm.
Seems to be a little more willing to budge publicly, and I think that will behoove them. I do. My guess is there are probably some hurdles around Mexico's importation of Chinese goods that's going to be a hurdle to revamp those supply chains. But I tend to agree with you. I think that Mexico's got to be a no-brainer, if for no other reason, and really Canada too, if for no other reason than Trump's last term, he put in place USMCA, which is just supposed to bring us into more cooperation. And I think for that reason, maybe not immediately, but in the next few weeks, months, clear heads will prevail and they'll get back on that path. But I think a lot of those negotiations are really going to center around really siphoning off the inflow of Chinese products and maybe leaning on more allies of the United States.
Yeah, makes sense. Okay, good chart.
This is maybe neither here nor there, but I found this kind of funny. This is from March 3rd through April 22nd, and this is only related to stock markets, though I would say that the same impact has been felt within industrial metals as well. And that's that when they first started talking trade and tariffs, they let Peter Lutnick, Lutnick and Navarro, I'm blanking on their first names at the moment, on TV quite a bit. They got a lot of airtime, and every time they spoke a very hard game. They seem to be the ones who came up with this trade deficit notion on setting the reciprocal tariffs. And it just seemed like every time they got in the headlines, the market cratered. And this chart kind of supports that, which was risk assets, whether it's industrial metals, the stock market, whatever. Lutnick and Navarro tended to be pretty bad for the performance of those assets. Whereas on the flip side, in recent weeks, we've seen quite the opposite, where it's almost like they gave Lutnick and Navarro less airtime so that they could call markets down, reduce panic a little bit, because I think approval ratings for Trump were going quite negative quickly. So it seems like Scott Bessent has been more of the banner carrier in the last 3 weeks, and perhaps no coincidence, the month of April has seen, and you'll see it in the metals charts, we kind of came in like a lion and out like a lamb. And it's because the first week was Lutnick and Navarro really stirring the pot and markets kind of panicking. And then after about the 8th or 9th of April, they kind of pushed them to the side and really let Bessent come in and start talking a little softer tone, talking about how we really do want to get a deal done with China, how 175% tariffs don't make any sense and they will not be permanent. And I think those things help to calm down the market. So again, this may be more of a neither here nor there, but I found it kind of interesting that they've had that strategy in the last 3 weeks, and markets have responded both within equities as well as metals.
Howard Lutnick, Peter Navarro, right?
Howard Lutnick, Peter Navarro. Yep. Yep.
There you go.
And it is worth noting, Howard Lutnick was actually on CNBC just a couple hours ago. This is Tuesday afternoon, and he did not rattle the markets. He actually spoke pretty optimistically about bringing manufacturing back into Arizona, and so maybe he's taking a different tone. Maybe he got a talking to. That being said, given all of this data, given all of these surveys kind of breaking down, the economists who comprise this survey for Bloomberg, they are 10% higher in, this month versus last month in terms of a recession within the next 12 months. 40% is nothing to panic about when we look back to 2022, 2023, where we were much higher numbers. But I do think, in my personal opinion, if we don't start to get trade deals, we don't start to see what a blueprint of a success looks like in the next couple of weeks, I think this risk does, in fact, grow. I do think that these surveys, where if trade deals get done, I think these surveys can actually flip positively pretty quickly. But if the trade deals don't get done, we don't see a little more about deregulation, we don't see any more about tax reform, then I think we do have some headwinds we probably got to deal with in the next 6 to 9 months. But it's going to be interesting to see how those things develop. And similarly worth noting, the IMF, which is the International Monetary Fund, they did lower their growth forecasts for the United States as well as a number of other regions around the world. But very much so worth noting, they lowered their growth forecast to 1.8% for this year, 1.7% for next year. Those are, as a friendly reminder, those are not recessionary numbers. We would need to see 2 negative quarters of GDP negative growth, not slower, just actual negative growth. And so we're, at least based on these forecasts from the IMF, we're nowhere near those types of numbers. Slower, yeah, but certainly not dire conditions as they're seeing it right now.
Okay.
And given sort of all these crosswinds, all these surveys kind of telling different stories from the hard data, we've got the Fed who's really been sitting on their hands to the lack of excitement of President Trump. The current expectation is that Jay Powell will begin, and the Fed will begin cutting somewhere around the July meeting. That at that point in time, we'll have enough data to see whether or not these tariffs do in fact create, higher inflation numbers, higher CPI numbers, or if alternatively these tariffs cause enough of an issue for jobs, layoffs, things like that, that we actually need to make a more aggressive stance on cutting interest rates and softening the blow to the downside. So as it sits right now, current expectation is basically 1 to 2 cuts for the balance of the year, starting in July.
That would be 3 prior to this, right? Three cuts in the past year.
I believe that's right. Yeah.
Okay.
And so just kind of circling back on all of the macro data, thus far, the survey data is broken down pretty quickly in the last couple of weeks. I get it. There are a lot of very upset people about the policies that have been brought about. There are a lot of people who really don't like the administration. It does seem to be showing up pretty quickly within the soft data. But again, this can break 1 of 2 ways. We could either see the soft data flip and turn a little bit more optimistic if we start getting trade deals, or the unfortunate thing would be if we don't get more headlines in the next couple of weeks, we could start to see that hard data, durable goods, retail sales, things like that, start to move a bit lower, in which case I think the recession odds would increase at that point. So that's really what we're dealing with at the moment. As we sit here today, market seems fine. The macroeconomy seems fine, pretty mixed. Survey data I think is creating some noise, but it's pretty okay. So let's flip over to metals real quick. So you can see, this is a 1-year chart of LME nickel prices. We did back in the early April, you can see where that Lutnick-Navarro panic really kicked in. We got down to price levels that were in the mid to low $6 per pound range, which I personally didn't think we were going to see. When you look down on the bottom section of this is the relative strength index, which is kind of saying, are we in an overbought or oversold situation? We got into pretty oversold, scary situations in nickel, in aluminum, in copper, in stocks. There was a pretty big panic sell for the first week of April. What you can see is very quickly things recovered as well, and we're now back around $7 a pound. And it looks like this $7 area is kind of a happy home for nickel prices right now. We're not trading above the moving averages yet, but it looks like we're beginning to stabilize around the $7 area. And the reason why I think we are is again, because we are testing the cost curve of nickel miners. And so again, as a friendly reminder for those who haven't seen this chart before, this along the x-axis is all of the different producers and miners of nickel around the world. And over here on the right axis, this is essentially their break-even price. And so when you get down into prices that are $6.50, $7, you're basically saying that half of the industry is unprofitable. And it is worth noting that in the last week, Indonesia, which is the largest miner supplier of nickel in the world, they have implemented higher royalties on the mining of their both nickel and tin. And that's really in an effort to kind of make sure that they're getting paid, make sure they're getting rewarded for allowing people to, take this metal out of the ground. But what it also does is that increased royalty, and that's kind of depicted here with this orange circle here and in all the bar charts, the orange. With an increased royalty, what that's going to do, all things being equal, is it's going to increase the break-even price that a nickel miner needs in order to be profitable. So I do think that those royalties should be helpful to slow production a little. They should be helpful to raise the break-even price a little. And for that reason, I think the $7 per pound range is going to look to be a pretty comfortable area for around the lows. I'm not saying we've hit the lows absolutely, but I think we're going to see some price support in and around that area.
Interesting.
And last but not least, on the stainless and nickel side, in the last week, North American Stainless sent out this letter indicating that in the next 3 months, they are going to implement their own tariffs, and it's going to be embedded into the surcharges of stainless. We don't have all the details yet, but we do have the May increase detailed down here for non-nickel bearing and nickel bearing alloys. They're not massive. I don't think they're game changers or anything, but it is certainly symbolic of the idea that their own cost increases are forcing them to pass that through to customers. So again, we hope that it doesn't, break down the stainless markets here in the United States. I don't think they're large enough to do that, but it is interesting. It looks like we're going to see 2 more rounds of this in the June surcharge and the July surcharge as well.
To reiterate, does each mill kind of set their own surcharges? And I know NAS is the biggest. But would that make another producer more cost efficient?
Yeah, and so I'll give you my thought, and I would encourage you to ask Jim Reed the same thing when you have him live. But
Noted.
Yeah, I mean there are really only 2 to 3 main players within North American stainless markets.
Yeah.
So probably raises the odds of, if one's doing it, the other one's going to see that as an opportunity to say, well, I have grounds to also pass through my increased costs. That's my gut feeling, but I don't have any real good insider intel there.
Yeah, that's interesting. Okay.
Switching over to aluminum, very similar story, and maybe even larger to the downside in terms of the move that we saw on LME aluminum ingot over the last month. You can see just 30 days ago, we were trading at $1.25, and very, very quickly as markets started to sell off, stocks were tanking. Aluminum is no exception. And you look down at this relative strength index, typically anything below 30 is suggestive of oversold conditions. The aluminum market got all the way down to like 13 or 14, which is like a 3 or 4 standard deviation move to the downside, which means it doesn't happen very often. And the good news for producers is that it didn't last very long. The bad news for consumers is it didn't last very long. We have rebounded a bit. There has been kind of a dead cat bounce, similar to nickel, where we've seen prices go from about $1.05 back up to $1.12. My personal opinion, I think probably $1.10 to $1.15 looks like a fairly healthy and natural range for aluminum for the coming months. Again, not investment advice, but I think it's going to be fairly range bound. I don't think we need to be all the way up at $1.25. I don't think $1.05 made a ton of sense either, but somewhere in the $1.10, $1.15 range seems like a healthy area where both producers and consumers are relatively happy. Now on the Midwest premium side, not a massive move, but a couple cents. We have seen the Midwest premium futures move slightly higher. The blue line would be as of a month ago. The white line is as of today. What I think is happening there is, and I believe we noted this last month in the Cup of Joe, as I understand it, back in November, December, January, there were a lot of pre-tariff aluminum ingot units that came into the United States. They basically came in around, let's say, 20 cents a pound. Then the tariffs went into effect, and everybody was thinking the spot price was going to go to 45 cents, 50 cents, 60 cents, and it never got there. And from what we understand, those pre-tariff units of ingot were kind of getting discounted out in the market. So they were saying, well, if I can make 15 cents and sell this ingot that I brought in for 20 cents at a 20-cent premium, sell it for 35-cent premium, I'm going to do so. That's a great trade. And so we understand that was taking place quite a bit over the last couple of months, probably still taking place a bit. But there is going to be a point in time as we roll through the next few months where those discounted pre-tariff ingot units aren't going to be out in the market anymore. So then we could actually start to see premiums move into the 40-cent range. So we're not going straight there, but it does look as though we are creeping ever so slightly higher on Midwest premium futures.
I remember around that time, I messaged you on occasion throughout those 2 weeks going, why is it going lower? Do I not understand this right? Or
Yeah,
you're
yeah.
probably saying, shut up.
Yeah, because just the straight up math would say you should have been
Yeah,
somewhere around 45 cents to 50 cents. That's what all the
yeah,
prognosticators around aluminum were saying too. And then yeah, we started to see pressure on the spot number, and we're like, what's going on? And that was
yeah,
kind of when people were like, well, somebody brought a whole lot in right
yeah,
before the tariffs went into effect. But at some point, we're going to work through those stockpiles.
yeah.
On the carbon side of things, it does feel as though we're getting a little peaky. I probably said the same thing last month, and you can see we've sort of been plateauing. I would say the market's held up at these prices a little better than I would have expected. Nucor CSP is still trading at 930. Fast markets is still trading in the 925, 930 range. So spot indexes are holding up, and I think Cliff's numbers all the way up at 975. Although that one probably carries a little less weight in the market. But the CRU just came in last week at 945. We'll have to see what Wednesday's number is, and I won't have that information obviously because this is recorded. But there is an expectation we're going to see a little bit of softness in the coming months, and I'd say for a couple of reasons. One is demand is just kind of okay. It's not horrible. It's kind of flattish year over year on numbers that are already like not that wonderful. So the demand probably doesn't support a mid 900s type number. Tariffs do help. Tariffs certainly raise the floor under which imported product can ultimately come in. But I think just given the fact that we aren't seeing demand going gangbusters in the first quarter and beginning of the second quarter, prices are probably going to peak out here in the coming weeks. Now, how much do we sell off from here? That depends on who you ask, but the futures market is kind of saying somewhere around the range of about $75 to $100 in the next 3 or 4 months. The good news for anybody who watches the hedging markets is it's already built into the price. So if anybody wants any fixed pricing for the balance of the year, we can already access this cheaper pricing and offer any one of our customers that cheaper number using the futures contracts. So keep that in mind if you're like, I don't really want to wait around. I'd love to get an insurance contract and lock those numbers in because we can make some money at those types of prices. We can do that for you. The other thing that I think's weighing a little bit on carbon prices is scrap. Scrap flows have slowed down a little bit to foreign sources. I'd probably say namely to Turkey. The better weather here in the United States is actually allowing more supply to come available. The expectation is that in the month of May, we'll see scrap prices again lower by another $30. So what does that mean? That's just lowering the cost under which an EAF, an electric arc furnace producer can make profits at lower numbers. So I think we will see a little bit of pressure on carbon sheet prices we roll through the next couple months, barring additional tariffs and things like that. But I don't expect further steel and aluminum tariffs at this point in time. And last but not least, my favorite phrase, copper prices, which I think there are a couple things that are interesting to point out about this chart. One is copper prices did roughly the same thing that aluminum, nickel, and really all risk assets did, except for carbon, did over the last month, which was they had a very swift sell-off. And what's crazy is it doesn't even look like it was that swift of a sell-off, but that's a 20% move from record high levels about a month ago to about almost $4 a pound. And then you can see the knife edge back up. We're already back up near record highs. And I find this interesting for a couple of reasons. One is the volatility was immense. It was just huge moves in just a matter of days in the price of copper. But when you take a step back and you look at a 5-year chart, it's pretty fascinating to think about copper prices still being right around record high levels. Oftentimes, economists like to say copper has a PhD in economics because whatever's going on with supply-demand conditions in copper is a good representation of what's going on in the manufacturing economy. If we believe that to still be true, and I do to some degree, then this really tells a story that is not recessionary on a global basis. This tells a story that there's a very balanced and maybe even very tight market that exists within the copper world. And I think that needs to be appreciated because again, this is not telling a recessionary story at the moment. There are some things that have taken place on the supply side in South America that maybe have artificially tightened things up a little bit. But you think about AI trends, green energy trends, computerization of everything. we're going to need more copper. And
Copper. Mhm.
Ryerson does not, we don't play as much in copper as some of the other industrial metals. But I think this is a pretty interesting chart because it does sort of buck the trend of a lot of the other metals we watch, which is telling kind of a long-term elevated bull case story.
Yeah, first thing I thought of when he pulled this up and saw it spike up, because yeah, like you said, it always is kind of indicative of the trend, the Dr. Copper
Yeah.
analogy you always
Yeah, I
make,
mean,
right? Yeah.
you look over the sea and go to China. There's still certainly some negativity going on within their property sector, which would heavily weigh on rebar, iron ore, cement markets. But you look at other areas where you think about the EVs that are coming out of China, and some of their companies that are becoming the biggest car companies in the world in a very quick fashion. That's more copper demand. You think about
Hmm.
some of these artificial intelligence models that are going to need more and more data centers, more and more wiring. That's more copper demand. It certainly seems to be bucking the trend of any recessionary story.
Yeah. Yeah. Good stuff.
So I think that's all I got on this end. Again, I really apologize that the schedule couldn't work for me to do this live, but hopefully everybody enjoyed the content. And again, Mike, if there are questions, you wanna give them an idea on how they can reach us.
Yeah, yeah. So we have the cupojoe@ryerson.com. That's CUPOJOE at ryerson.com. And certainly, if you want, when we're talking to product managers, drop questions in the chat for Nick too. We'll kind of put those on the side, and we'll either answer them in a show, or we'll email them off. We'll get your answers in some way, shape, or form. Nick, great stuff as always. It's a mix of optimism and pessimism, I guess, right? I mean, just really no better way to describe it.
It's
I
a
guess
whirlwind, man.
yeah, like what's your takeaway from all this? Give us one key takeaway right now.
Yeah, I mean, I think I try and steer on the optimistic side. I'm not
Yeah.
trying to say that I love everything that's taken place over the last couple months. I don't.
You're Dr. Doom. You're not positive. Don't
fair.
lie.
That's fair. Well, I'm trying to turn over a new card. We're getting into springtime. I'm feeling good about things. The flowers are springing up.
Okay.
And
Spring
yeah,
day.
I think that here in the coming weeks, we're going to begin to see the blueprint for what this new world order of trade is going to look like. And I think once we have a better picture of what the rules of the game are, we as businesses can make better CapEx decisions. And so I think it's going to get easier. I think it's going to get more clear. But if it doesn't, we're happy to hop on in the next 2-3 weeks and do another one of these if we have to. But worst case, we'll be back on in June, and I look forward to talking to everyone.
Thanks, Nick.
Hey, thank you, Mike.